Welcome to Everything Financial Radio. I'm your host, Dennis Tubbergen. This is the Legacy Radio Network. Have a terrific show lined up for you this week. Best-selling business author, Mr. Robert Wiedemer, will be with us. Mr. Wiedemer is the author of Aftershock, Protect Yourself and Profit in the Next Global Financial Meltdown. We'll get his view as to where the economy's going and what you should do to protect yourself. Very much looking forward to that conversation. Also, Iran thumbs its nose at the U.S. We don't need U.S. dollars to do business, they say. And government regulation. I'm going to get up on my soapbox for a minute. It doesn't lean right or left. It leans forward. So if you happen to be to the right or the left, don't turn the dial at this point. But you would be probably even shocked, is the word I would use, as to what the government bureaucrats were up to in the state of Pennsylvania recently. I'll fill you in. Some more evidence of deflation. Are we seeing a continued contraction in the credit markets? And we'll ask, I'm going to share with you a very interesting article I stumbled on this past week. Is the United States the new Roman Empire? We all know what happened to the Roman Empire, and I'm going to show you some very interesting parallels and pennies and nickels, the little bits of change that you carry around in your pocket. Is the composition of pennies and nickels about to change? Do you know that it costs about 11.2 cents to make each nickel? So only in the United States would we have 11.2 cents on something that is worth 5 cents. Unfortunately, for those of you that are entrepreneurial, you can't melt them down. That's called debasing U.S. currency. So wouldn't recommend that either. We're talking about what's going on in the economy, and we talk about economic cycles, and we do this at our discovery groups. They have been very, very well attended in 2012. Actually, we've had a number of discovery groups where we actually have had to turn some people away. We do have some discovery groups scheduled, added a couple due to demand. We'll be down in St. Joseph on February the 28th. We'll be out in Alto at Saskatoon Golf Club on Thursday, March the 8th. We'll be at the AMG Business Center in Norton Shores, which is near Muskegon, on March the 13th. And on the 15th, we'll be out in Belmont at Boulder Creek Golf Club. You can go to personallegacyseminars.com. That's personallegacyseminars.com. And get more information, learn a little bit about the topics that we are going to be covering at those discovery groups. Also, if you've not yet visited investingapproach.com, you can go there and still request, we're still making it available, our 2012 Market and Economic, easy for me to say, Market and Economic Outlook Home Study Kit. That's at investingapproach.com. You'll see everything in the kit there. You can request it. Just let us know where to send it. There's also an explanation of the economic cycles there. So certainly invite you to go visit investingapproach.com. Also, wanted to point out to everyone that if you want to get more information about the book, Economic Consequences, which is my book that was published last year. The book is titled Economic Consequences. Can you survive, even prosper from 100 years of bad money decisions? That information is also at investingapproach.com. There are limited copies available. So, again, go to investingapproach.com and you can get more information. I am privileged to have with me today on the Everything Financial Radio Show Mr. Robert Wiedemer. Bob is Managing Director of Absolute Investment Management, a macro-focused money management firm, about $250 million under management. Also author of Aftershock, New York Times and Wall Street Journal bestseller. Also authored back in 2006, America's Bubble Economy, which accurately predicted the real estate, stock, and private debt bubbles of 2008 and 2009. So, Bob, very much a pleasure to have you on the show today.
Well, thank you for inviting me. It's good to be here.
Bob, in Aftershock, to jump right in, you outline what you believe will be the coming sequence of economic events. Can you give our listeners an overview, macro picture of where we are economically speaking, in your opinion, and where we go from here?
Sure. I guess the grand overview is basically what I talked about America's bubble economy is there's four big bubbles, as you said, the stock, housing, private credit, and discretionary spending. And those four bubbles have come, and deflated, as we all know, unfortunately. But what we've done, which we talked about in Aftershock, is we have pumped up those bubbles again, or at least tried to keep them afloat with the government debt and the dollar bubble, which essentially means, what we predicted, even in America's bubble economy, as we do that. And what I mean by that is we have basically massively increased the amount of money the government is borrowing, and we've massively increased the amount of money the government is printing, and that has helped kind of stabilize and pump up those four other bubbles more. So that's kind of where we are in the economic sequence of things. What we talk about, of course, in Aftershock is what happens if and when, and we think it's more of a matter of when, the government debt and dollar bubbles pop.
So you outline in Aftershock, which I would encourage all the listeners to pick up and read, your perspective on various sectors of the economy and how it might affect our listeners. And I'd like to start, if I could, by getting your feedback on housing. As you mentioned, the housing bubble has deflated. But from the comment you just made, would it be fair to say that it's your opinion that we're going to continue to see the popping, if you will, of that bubble?
Well, I think you will, because, as I said, think of how much, Dennis, the government has done to try to pump up the housing market. I know it hasn't got it back up to the bubble status, but it's done a lot to keep it from falling further or faster. Basically it controls the mortgage market now. It's taken over the entire U.S. mortgage market. We kept interest rates very, very low. The Fed's even talking about perhaps doing another round of buying bonds, and likely would focus on mortgage bonds. So we've done a lot to try to keep that housing bubble up, and I know it's been falling. My feeling is that at a certain point, we're probably going to get, right now, we may get a little bit of stabilization in some areas, maybe even some growth in a few areas, but fundamentally going to be drifting downward over the next year or two. And then the big issue comes, with all this money printing, if you start getting any level of inflation that pushes interest rates up. Now, I know nobody thinks that's ever going to happen, but I've lived through interest rates certainly much higher than today. Back in the early 80s, we all remember interest rates of double digit. But that's what I would be most concerned about later on with the housing. And even before that, if we have any trouble in the stock market, and I know it sounds funny to connect it to, but the stock market does serve a bit of as a confidence builder for people buying homes, even if they're not necessarily that active in the stock market. But the stock market's rising, people tend to be a little more confident in the future, and they tend to buy homes. If that stock market takes a big drop of 3,000 or 4,000 points, that could also hurt the market, the housing market. And again, that could happen easily even before we get higher interest rates on mortgages. So I'm kind of looking for a little bit of a drift down, then maybe some stock market problems in the next couple of years, and then I'm most concerned longer term about interest rates being driven up by inflation.
So a couple things you say there that I'd like to follow up on. Let's just follow up short term on your comment about the stock market. If we see a decline in the stock market, that could have negative effects across all the economy. When, as we call it, in the autumn season of the economic cycles back in the 90s, when the markets were going crazy, we had people going out buying boats, buying bigger houses, and now we have the opposite effect. But give us your forecast, if you will, for the stock market, for the major U.S. market indices moving ahead over the next, say, 1 to 3 years.
Sure, and it's good to pull it out that long because it's going to be quite an interesting run. Very short term, I think we could even have a pullback from where we are today. But I think by spring or whatever, we also could see the Fed print money. Even without that, we could see some more bullishness. I think there's a lot of bullish sentiment out there. I think the combination of some of that and certainly the Fed does print money could push this market to record territory. They pushed the Dow over 14,100. So I think that's what you might see short term. Now, there's some obvious issues that might, vote against that. Europe could blow up again. We could have a problem in Iran. But I think there's a real bullishness out there, and I think the Fed seems to be pretty willing to print money. You never can guarantee it, but they seem pretty willing to do so even short term. After that, I don't see it being sustainable. I don't think the economic growth in the U.S. is there to sustain it. Earnings growth is there. I don't think Europe or so forth. And I'm worried about China. I'm worried about a real meltdown in China as early as 2013. Not just a hard landing, but a real real estate bubble pop, kind of like what Spain had, and it could happen in China as well. And all of that causing that market to start to head down, and also just the fact that the economy has not moved that strongly in another year, and I don't think it will have, just puts pressure on the market. So over that period of 2 to 3 years, let's say, that's where I see the market starting to fall. Yes, the Fed's going to try to keep it back up, so you kind of might have a fight with a little bit of printing, falls, a little bit of printing. But overall, I think you maybe got 1 or 2 more printing cycles, and I think the market's going to fall several thousand points and stay down several thousand points until, we start to get bigger problems, which I primarily think would be inflation.
Well, and I want to follow up on that. We are chatting with Mr. Bob Wiedemer, best-selling business author of Aftershock. And, Bob, we have about a minute left in this segment, so we can start to talk a little bit about this, and I want to follow up on the other side. You're concerned about inflation moving ahead. Explain what your prediction would be on inflation. Then I want to follow up and get your opinion on some of the deflationary trends we've seen.
Sure, on inflation, the key thing to remember about inflation is there are huge lag factors when you print money and when you get inflation. There's an analogy called the fool in the shower. We all know when we get in the shower and you turn the hot water on, at first it's very cold, and then it keeps running cold, and then boom, the hot water finally hits. That's a lot like how inflation is at first, you turn it on, nothing seems to happen, and then it hits later on. So my prediction is slow, and then eventually it hits, and then it speeds up very quickly.
Well, we will talk more about the fool in the shower and inflation. That's a great analogy. I will use that and give full credit where credit is due, Bob. We will chat more with best-selling business author Mr. Bob Wiedemer, author of Aftershock, when Everything Financial Radio returns. Stay with us.